Hi everybody, this is Stephen from Share Navigator, and I thought it'd be a good time to produce a video to discuss the current volatility in the markets. So first of all, what you're looking at here is a chart of the SPY, which is an exchange traded fund of the S&P 500. And you can see here, we've had these sudden drops here recently. The market got up as high as 286, and yesterday finished at 258. So, and that all happened in a period of about 6 or 7 days. So what's caused this? Where are we going to from now? I think it's worthwhile listening to this video just to give you a couple of insights as to what's going on and to give you my tuppence worth as to where I see the market over the next 6 to 12 months. So the first things we got to do is really understand what's going on. Why the sudden correction? Is there something wrong in the market? Is there something wrong with the global economy? What's the catalyst that's causing all of this kind of sell-off? So really we have to come and look here at this particular chart here. This is the 10-year government bond for the US. And for those of you who don't know what a government bond is, it's basically where investors loan the government their money and then get a guaranteed interest rate every year for a period of time. And happens to be the 10-year government bond. So you can see really just back in December, all you were getting was 2.3%. And now all of a sudden we're getting 2.9%. So why is that so important? Well, there's a number of reasons why. These particular government bonds are considered risk-free assets, and risk-free assets, are hard to come by. So in other words, you can give your money to the US government and theoretically there's zero chance of you actually losing it. So what happens is you give it to the US government for 10 years, they invest your money in their schools, their road programs, etc., like that, and you get an interest rate every year for 10 years, and then you get your capital back at the end of the term. Or else you can close out your bond position early if you want. So why is that important? Well, if you think of fund managers who control large amounts of money, now they're starting to get faced with this decision-making process. Do I stay in risky stocks, or do I switch some money over to government bonds, which is a safer asset? Now, are we at that point where that decision is crucial now? I don't think we are. I think we have to be a fair bit over 3%. But I do believe that once we start approaching 3%, the markets would start coming back to realistic valuations. So the catalyst has, I suppose, two prongs of attack. First is government bond yields, a risk-free asset. But then the second one really was that the markets and stocks were simply overvalued in a lot of cases. So in other words, the market will now come down to realistic levels or multiples of earnings to take into consideration. Well, now, you know what, there's another game in town. I can invest my money into safer government bonds. Now, the real risk here is the inflationary data coming out of the US is starting to suggest that inflation is coming. It's nowhere near that 2% level. Why is that important? Well, if inflation starts getting overheated, the Fed may be encouraged to raise interest rates higher. These bond yields go up even higher again. And then you increase the risk of a recession. Also, if inflation is going up, wages tend to go up with it, which will hurt company profits. So there's a two-pronged effort there. And then the risks of a recession become higher and higher. So that's why the market is now recalibrating and saying, okay, the easy money is gone. It's time to recalibrate down to normalized levels. So we've got to understand now where we are at, where's the fair value for this market, and where possibly could we go in the future. So I'm just going to bring you back to that chart that we were looking at. So we've come back here to 258. These are just short-term moving averages here. That's your sell signal there when the 10 crosses the 20. And this is your 200-day moving average, which is at about 253 at the moment. So normally, the 200-day moving average is one of the main moving averages I look at because that's normally where, in times of correction, markets will migrate back to. So I see the market going as low as 253 and even lower than that. Another interesting fact for those of you who are trading options is look at the change in implied volatility. We went through nearly 18 months of low implied volatility, which made option trading very, very, very difficult. And then all of a sudden we get this spike here. So those of you who are holding deep out of the money short puts on SPY, they may look like losers at the moment, but I wouldn't panic. The reason for that is the jump in implied volatility has increased the prices of those options. So to cut to the chase, my view is we are now getting to some buying opportunities in the market. Are we there yet? No, it wouldn't surprise me to see this market below 250 and even as low as 240. That wouldn't surprise me in the least. If that happens, I think it's a great opportunity to buy. I'm going to share with you why. So first of all, the fears that are in the market now are at the moment are all kind of inflationary fears. You know, they're now analysts are saying the Trump tax cuts have come at the worst possible time when they're literally increased the debt ceiling in the US. So do you want to throw more money at an economy that's growing and inflate the economy and bring in inflation risk? But the fact of the matter is the inflation risk isn't there at the moment. Yes, there's potential for it in the future, but right now inflation isn't a big issue both in Europe and in the US. So from my perspective, we're simply just going to correct here and we're literally going to trade at normal levels. So the multiples of earnings that you've seen in the past, I think are gone. You're not going to see them again because the risks are now firmly in investors' minds. And we're going to get back to fundamental investing where you're going to see certain stocks go up because they're great value. Stocks that are overvalued are going to continue to go down. But then I think the market will normalize until we see evidence of inflationary pressures, and then you could see the market start to turn again. And I think we're 6 to 12 months away from that point. So this short-term correction is welcome. I think the fundamentals are still strong in the market, and I'm going to share with you why. So let's bring you into some of the research that's been done at the moment. So here we are looking at the estimates for this year for the S&P 500 earnings. So as you can see, since the tax cuts were implemented, etc., the earnings estimates have gone up substantially for companies. So you're looking at now on the S&P 500, the average analyst estimate is at 155 a share for this year. Now, normally the S&P 500 would trade at a multiple of earnings of 17. So we know our share price formula is earnings per share. Let's type in 155 multiplied by the PE ratio. So if the market does normalize, you're talking about by the end of the year, the S&P 500 operating at about 2,640 points. So in SPY terms, that's about 264 of a target area. Okay, so you can see why I'm saying that if the market drops below 250, maybe even to 240, I think it's a buying opportunity. If we, for example, then look out to next year, the earnings are looking to grow at about a 10% clip as well. So they're forecasting about 171 a share for next year for the S&P 500. Now remember, these are just estimates. They can change. And they will change if inflation becomes a problem. But right now, there's no evidence of that. So next year, what you'll be looking at is a target price on SPY of about 290. So if I'm picking up the S&P 500 below 250, or even at 255, I'm not going to be too upset. Yes, in the short term, I might look at short-term pain, but long-term, I think this market is going to trade somewhere between 260 and 290. And I think that's where we peak. My view is in the next 6 to 12 months, if inflation does pick up and interest rates do continue to go out, we could be looking at a market top maybe mid to next year, because earnings then will come under pressure, earnings growth will come under pressure, the risks of a recession will go up, and then the market may trade at a discount to what it normally trades at. So in the last year, we've seen the market trade at like 22 times earnings. It may, for example, go down to 15 times earnings to take into consideration we may have a recession on the horizon. But I don't think we're at that point now. I think that's 6 to 12 months away. And I do think we're going to retest those highs again eventually. Are we going to do it in the short term? I don't think so. I think this hasn't found the bottom yet. I think looking at the market right now, I think definitely the 200-day moving average will be tested. So that's 253. And if that gets breached, we could be going as low as 240. So that's where I think buyers come back into the market and pick it up. So I think we could go to 253 as my first target area where I go, yes, I'm going to start getting aggressive in the market. So how can you play this? I'm going to break this down into kind of two different types of investors. Those of you who have significant money in the market, if you're lucky enough to be in cash, there's no better time than to be putting it to work. So let me show you some examples. One of our favorite strategies, as you know, is the short put strategy. That's basically where we're ensuring the value of the market for a certain level. And right now, you could get paid. So if you look at the SPY, it's currently trading at 261. You could insure it for 40 points cheaper and get paid 170 in share. So in other words, if you insured 100 shares of SPY at $220, you'd be getting paid $170 up front for insuring it. You may or may not have to buy the shares at some date in the future. So I've been waiting a long, long time for this to come back into the market. And I think these are the opportunities. So if you have money, I'd be looking at the short put strategy. I wouldn't push everything in now, so I limp in. I maybe do it, depending on your portfolio size, for example. You might do a contract now, and if the market falls further, you could do another contract again later on. But I definitely would want to start becoming an owner of the SPY at that 250 level and below. I'd want to own some shares. So what I'm doing at the moment here is I'm selling puts. I've got 255 puts sold, I've got 240 puts sold, I've got 230 puts sold, I've got 220 puts sold. I don't think we're going to get to the 230 level. I could be wrong. There might be more volatility out there. But I do think I'm going to have an average ownership price in the market of about 245 to 250. That's where I think I'm going to own it. And my view is I'll be selling out of that at about 280, 290 within the next 6 to 12 months. So if you don't have a lot of money to trade with, and selling short puts is not an option for you, you could simply wait for this to bottom. And when it does bottom, I will be buying the index. I would not buy individual equities unless you're really confident of your research. I would buy the market as a basket below 250. And at that stage, just be patient, go asleep and wait for it. I do think you're going to see it higher. So if you're owning at 250 and the market, for example, goes to 3,000, that's a 20% increase. I don't think it'll quite get to the 3,000. I think 290 is probably where I see it at. And then I'd be looking to exit. I wouldn't be greedy. I'd probably get out at 280. So there's two different ways to play it. If you've got a few bob, sell put options. If you don't have a few bob, I wouldn't even do the bull put spread. I would literally wait for the market to fall further and then become a buyer below 250. And you've seen the reasons why and my explanations why. The one thing to watch out for, though, is inflation data. Keep your ears and eyes open for that over the next few months. If inflation starts creeping up and creeping up and creeping up, we may have to revisit our targets because that will become a problem. It will become a problem for wages, which eats into profits on companies. And then, of course, interest rates, if they're going up, it's making the cost of living higher. And then, of course, that reduces consumer spending power. And then all of a sudden, we could be talking about a recession the year after next. So you need to keep an eye on that. I don't think we're finished with this bull market yet, but I think we may have 6 to 12 months left in it. Okay, this is Stephen from Share Navigator. I hope you enjoyed my explanation. Please feel free to contact us if you have any questions. Thanks and bye.